Imagine it's March 12th, 2026, and something huge just landed. BlackRock, the biggest asset manager on the planet, has just launched a product that completely changes how we think about crypto. We're talking about turning Ethereum from just a number-go-up asset into a real, legitimate source of monthly income. This is an absolute game changer, and it taps right into that classic Wall Street story, the never-ending hunt for yield. And now, that hunt has finally come for crypto.
And you gotta listen to the language here, from BlackRock themselves. This isn't the usual crypto hype. This is Wall Street saying, hey, we're doing this because our mainstream investors are demanding it. They're not looking for a moonshot. They want solid strategic additions to their portfolios. The most important word on this slide, income. They've finally figured out how to take crypto's native yield, bottle it up, and sell it in a package everyone understands. And that changes everything.
So you can really see the before and after picture right here. The old way of doing crypto, it was all about price speculation. You bought some, you hoped it went up, and you had to deal with the technical nightmare being your own bank. The new way, the one BlackRock is pioneering with ETHB, you get exposure to the price, plus you get an income stream. It's all wrapped up in a regulated package that's built not for the degens, but for your average everyday investment portfolio. In short, crypto is finally growing up.
But here's the thing, and this is super important. This isn't just about one fund. What BlackRock has actually created is a replicable blueprint, a model for taking a whole class of digital assets, the ones that run on something called proof of stake, and turning them into investments that spit out yield. They've made it look and feel like a traditional investment that a financial advisor can actually get their head around.
So what's the magic behind all this yield? Well, it's a process called staking. And honestly, it's simpler than it sounds. You're basically just pledging your crypto to help secure the network and process transactions. And for doing that, the network pays you rewards. The best analogy? It's really similar to earning interest in a high-yield savings account. It's a feature that's been built into these blockchains for years, and now BlackRock has built the superhighway for big money to access it.
And when you break it down, it's this incredibly simple but powerful three-step blueprint. Step 1, you take a big proof-of-stake asset, like Ethereum. Step 2, you lock up a big chunk of it inside an ETF, that easy-to-buy, regulated package. And Step 3, the best part, you collect all the rewards, turn them into US dollars, and mail a check, digitally, to investors every single month. It's basically a financial assembly line for minting crypto yield.
Okay, so this is where it gets really interesting for the future. This blueprint, it's not just for Ethereum. You can apply this exact same model to other major cryptos like Solana, Cardano, Polkadot, you name it. BlackRock basically just kicked the door wide open, and you can bet their competitors are watching and are going to rush right in with their own versions. So this isn't just one product launching, it's the birth of an entire new asset class.
Now you might be thinking, how is this even possible? Because for years, the very idea of a crypto ETF that generated yield in the US was dead on arrival. So what changed?
This timeline kind of lays out the dominoes that would have to fall for something like this to happen. First, you get the actual real-world approval of the Bitcoin ETFs back in 2024. That broke the dam. Then, let's say a big piece of legislation passes. We're calling it the Genius Act, that creates clear rules of the road. And the final piece? A change in leadership at the SEC. A cascade of events like this is exactly what paves the way for a product like ETHB.
And you can't overstate the difference here. Under the old SEC leadership with Gary Gensler, companies were literally told to remove any mention of staking from their ETF applications. It was a complete non-starter. But with new leadership and a law like the Genius Act providing cover, the whole attitude flips 180 degrees. This shows that a launch like this isn't some random exception. It's part of a much bigger systemic shift. All right, so the regulators are on board. Let's get under the hood and see how this thing actually works. How does a fund like ETHB take digital rewards and turn them into cold, hard cash in an investor's pocket? The first thing you notice is this number. We're talking 70 to 95% of the fund's assets being staked. That tells you everything. This isn't just a fun little side feature. The primary job of this fund is to generate yield. That small slice they keep on the side, that's just for liquidity, so they can handle people cashing out every day without messing with the core operation. So where does the money go? This is where it gets good for the investor. A whopping 82% of all the staking rewards generated goes straight to the people who own the fund. The other 18% gets split between BlackRock for managing the whole thing and their partner Coinbase, who handles all the complicated tech stuff. It's a structure that's clearly built to be a really good deal for the end investor.
So if you're a traditional investor, think about what this means for you.
You get a monthly cash dividend. Simple. You don't have to worry about running computers in your basement or managing weird digital wallets, because giants like Coinbase do it for you. And the tax man? He's happy too, because it's all treated as ordinary income. It's staking with all the hard parts just abstracted away.
So, what happens now? What are the ripple effects now that the biggest player on Wall Street has basically given its stamp of approval to crypto yield? The consequences are going to be huge.
Well, first off, you've got this really fascinating supply and demand thing going on. See, a staking ETF doesn't just hold the crypto, it locks it up. So every single dollar that pours into ETHB takes more ETH off the open market and puts it to work. And I mean, it's Econ 101, right? What happens when you shrink the supply of something while demand is growing?
And if you want to get a sense of just how big this could get, you just have to look at BlackRock's track record. Their Bitcoin fund, IBIT, over $55 billion in assets. The regular non-staked Ether fund, ETHA, over $6.5 billion. ETHB is now going after a completely new group of people, the income investors. The amount of money that could flow in from them is just massive.
You know, when a giant like BlackRock enters a market, they don't just participate, they set the terms. And this move just cranks up the heat on everyone else. You can see it here. ETHB is a brand new fund purpose-built for this. They're super transparent about that 82% reward split, and their fees are designed to be killers. This instantly creates a new standard that forces competitors like Grayscale to either adapt or get left behind.
And what's really smart is that ETHB doesn't replace their old Ethereum fund. No, it sits right alongside it. They're giving investors a strategic choice. If you just want to track the price of Ether, great, buy ETHA. But if you're looking to add an income component to your portfolio, now you have ETHB. It's product segmentation, classic Wall Street style.
So all of this brings us to the big final question, right? With the world's biggest asset manager now packaging and selling crypto yield as a monthly dividend, have we finally hit that tipping point? Is this the moment when a digital asset like Ethereum finally becomes something like an internet bond, a core income-generating piece of a truly modern portfolio? It's a huge thought, and with a product like ETHB out there, the answer just might be yes.